Module 4, Lesson 2, Balance Sheets and Bank Records. So, first thing we're going to talk about is acquiring wealth. So, there are two types of assets: depreciating. That's the first type we're going to talk about. They're possessions that decrease in value over time. So examples: a car. As soon as you drive it off the lot, it's not worth what you paid for it. TV. As soon as you take it out of the store, you can't get what you paid for it. Laptop. As soon as you open the first app on that baby, it is no longer worth what you paid for it. So those are depreciating assets. Then we have wealth creating assets. Possessions that generally increase in value over a time or period with a return. So, real estate. General maintenance and upkeep on your home usually leads to it being worth more in the long run than you paid for it. You put your money into savings with interest, it should increase over time. If you buy stocks or bonds, we'll talk about those, and that's all wealth creating assets. There are some liabilities in life. So what are some examples of liabilities? Your mortgage on your home, your payment. That's a liability. You have to pay that. How about your car loan? How about student loans? How about medical bills? Then we can just look at credit cards or credit balances, store cards, anything of that nature that we owe. Those are liabilities. So when we develop a balance sheet lists all of your assets and liabilities. And if you take your assets and subtract your liabilities, you wind up with what we call your net worth. So, let's say you make $5,000 a month. That's your assets. That's your coming in money. And you own a home, and you own a car, and all of this stuff. Then you subtract your liabilities from that, the payments on everything, and that how much you got. The difference of those is your net worth. Because theoretically, you can cash all your cash all your assets in, cover your liabilities, and still have money left. Two of the most popular services provided by banks: checking and savings. Checking accounts. Account owners have the privilege of writing checks on their account and are able to use debit and ATM cards to access their funds. In a savings account, account owners are paid interest on the amount deposited in the account and left alone. These types of accounts provide a safe place to store money. The FDIC, which is the Federal Deposit Insurance Group, insures deposits in bank accounts up to $250,000. So if your bank goes broke, you got money in there, still going to get you money because of the FDIC. FDIC. I'm going to put group. It's corp. Sorry. C-O-R-P. Corp. Corporation. C-O-O-R-P. I'm losing it. Okay. A credit union. Sometimes you're going to get to work for an employer that offers a credit union for you. Used by people who don't have a checking or savings account. While the services are quick and convenient, there are the same services offered for free by local banks. Example, let's say you work through a temporary agency. Most of them make you sign up for some card that they can deposit your money to, so they don't have to go to the bank, basically. Okay? 4.2, page 2. Tracking your dough. So, when you tracking your account, taking out more money than it is in the account. Okay? Bank charges account. What is that? Overdraft. That's supposed to be overdraft. I'm telling you, overdrafting. Drafting. Guys, it's Monday. Take out more money than is in the account. The bank charges the account holder a fee for doing that, and it can be pretty high. To keep track of your checking account, you need to know the amount of each deposit, withdrawal, check that you write, and any purchase you make with a debit card. Lots to keep up with. Banks provide bank account registers, which is essentially a table in which you can record important information. What is a check? Registers. I spelled that right. Basically a promise. Piece of paper. You promise from you to the recipient, indicated that you authorize the bank or the release or the transfer of funds from your bank account to the recipient. 10 necessary elements of a check. Okay? You must have your address on there. The pay to must be filled out, who you're giving it to. The amount. Let's say it says $50, like that, $50. The amount in words. Like that. Got to write it out. 50 and no cents. The check number must be on there. The date. There is a lock symbol on all checks. Maybe a watermark. Maybe most of them are watermarks. Your signature has to be there. And at the bottom of the check, you have your routing number and account number. Legal checks have all 10 of those items. So when you balance your account is an easy way to double check your record. Balancing your account is an easy way to double check your record and also the records that your bank has kept. General steps for balancing an account. First of all, compare the items on the bank statement to the bank account register. If you've kept up with it, you should. When you have checked off each statement transaction in the register, enter the ending balance shown on the bank statement in the box on the bank statement worksheet. There's a worksheet. You can find this information online. You need to print out worksheets for balancing your bank account. Step 3. If there are checks, that's an ATM withdrawals, debit card transactions, or fee amounts that do not have a check mark, buy them, enter them in the items outstanding section. Area on the bank of the bank statement worksheet. Step 4. Calculate the total of the outstanding items. Step 5. Subtract those items from the ending balance that you found earlier in step 2 and enter the number in the total balance box in the bank statement worksheet. Those are just steps to follow. It's not really self-explanatory, but it is. And you can download a bank statement worksheet online from lots of resources that will help you make it through that process. Hey, that's the end of 4.2. There is a practice. Have a good day.